Hello everyone. In this clip, we will learn how to find insurance premium for an economic agent using expected utility theory. So let's consider an economic agent which faces uncertainty of the following form. The agent could earn 62,500 if the good state occurs, whereas the agent could end up only with 10,000 if there is a bad state, and the probability of bad state occurring is 0.8, and the probability of good state is 0.2. This agent need to ensure some smooth functioning and smooth consumption, and therefore there is a need to buy insurance. However, how much amount of money the agent would be willing to spend on buying insurance needs to be figured out, right? So to do so, we use the expected utility theory. According to this, we need to first figure out what would be the expected utility of the agent from the uncertain situation that is being outlined in the previous slide. So expected utility is nothing but probability of a good outcome happening into the income under that good scenario plus probability of a bad outcome happening times the income or the utility from that bad outcome. However, to figure out the expected utility, we need a explicit utility function. Let's assume it is 2 times root income. If therefore the income is 62,500, root of 62,500 would be 250, and multiply it by 2 because it is in the utility function will leave you with an utility value of 500. And if the income is just 10,000, your utility from that figure would be 200. And now take the weighted average that would provide an expected utility figure of 260. So this 260 is a number that needs to be protected so that the risk averse agent here can opt for some sort of insurance. So any money that can ensure this 260 units of utility would be good enough for this person to maintain consumption smoothing. Any money above that level of utility would or could be used for buying insurance. Now to do so, we also need to find expected income, which is weighted average of the incomes derived under an uncertainty, and we'll see that later. Now, before we could find insurance premium, we also need to find a number called certainty equivalence income. In the previous discussion, we saw that the expected utility from this uncertain scenario is just 260. And this is an important number. So we need to find an income level which will protect this 260 income utility from income. So certainty equivalence is simply that level of income that will ensure this expected utility level of 260 if that income is given for sure, or it is guaranteed, or it is certain. So that is the idea of finding certainty equivalence, because any income above certainty equivalence could be used as insurance premium because the person's expected utility is protected. So using the utility function, we can find a certainty equivalence. So just replace the expected utility in place of utility and simplify this, which will give you root of income under certainty equivalence equal to 130, because 260 by 2 is 130, and to remove the square root sign, the equation is squared on both sides, and that leaves us with a certain equivalence income of 16,900, which is 130 square. So it means if we can ensure this agent with an income of 16,900, this person's expected utility value of 260 would be protected. And that means any money above and beyond this is available to be used to buy insurance. And that amount of money is, in this case, is 3,600. How did it come about? It's because risk premium or insurance premium is your expected income from the uncertainty minus certainty equivalent income. Certainty equivalent income we just found out, and expected income from this uncertain situation is 20,500. That's 0.2 into 65,000 plus 0.8 into 10,000. So in this case, the person's insurance premium would be 3,600. He or she would be willing to pay to ensure that even if income goes below 16,900 to say 10,000, this person would be still able to maintain an utility level of 260 because the insurer will provide with, compensation. Okay. Now this problem we can see graphically. So here we have income and utility plotted here in the form of total utility. If income goes up, utility goes up as well, but at a diminishing rate. Now, going by the problem at hand, we had an income of 10,000 in bad state, which yields an utility value of 200. And we also had a good state with income level of 62,500, which yields an utility value of 500. Now, this also, is possible to find the expected income because the 10,000 and 62,500 incomes are not coming with certainty. It's associated with uncertainty, but on average, this person's income would be 20,500, which will give an utility value corresponding to the U of 20,500. Since our purpose is to find insurance premium, we need to figure out the expected utility, which is simply the linear combination of utility from 10,000, which is 200, plus utility from 62,500, which is 500. In other words, it's simply 0.8 into 200 plus 2 into 500, and that gives an expected utility value of the number we found, that is 260. This is the 260 level, right? This is the 260 level, and this is the 260 level, and that way, that is the expected utility. Now, if you draw a parallel line to the utility function, you have a level of income which is to be ensured with certainty that will give same utility as the expected utility of the problem. So that level of income is therefore nothing but it is 16,900 because the height of this expected utility is maintained. And that is where the solution and last step is to find the insurance premium. So to find the insurance premium, you just need to find the difference between expected income and certainty equivalent income. So your expected income is 20,500 and your certainty equivalent income is 16,900. And this gap is what is your insurance premium that is reported in the earlier slide, 3,600, right? So this way, using expected utility theory, you could figure out certainty equivalence and insurance premium. The calculation of insurance premium will vary depending on how much risk averse the person is. So in this case, we have a square root function. There can be more risk averse person than this, or there could be less risk averse person than this, which will also affect the value of insurance premium according to the expected utility theory. So I hope this is understood, and I hope you could be working out on problems that deals with uncertainty in this using this economic tool. All right, see you later.